Welcome everybody to Volatility Trading Strategies. So in several of my past videos, especially the ones where I'm talking about reducing overall portfolio risk, I always mention something called constant portfolio rebalancing. In my opinion, it's an absolute must that investors understand and implement this long-term strategy. There's many reasons why, but two of the big ones are, first, it can dramatically reduce drawdowns and smooth out overall performance, which I hope is everybody's goal. Of course, making big profit is always fun, but smoother performance is what allows investors to psychologically be able to stay the course and stick to their long-term plan. When drawdowns get too large, we start to make bad decisions. But secondly, regular portfolio rebalancing does allow you to take on some additional risk. You can add some higher growth strategies to your overall portfolio without significantly increasing the risk. So simply put, regular portfolio rebalancing creates both a safer and a more profitable portfolio in the long run. Who doesn't want that? So subscribe to the channel, give the video a like for me, and let me show you why this topic is so important. So let me first give you a very basic example here for why portfolio rebalancing is so important. Let's say you have a buy and hold portfolio with 3 assets in it. Asset A returns 10% a year and you allocate 40% of the portfolio to it. Asset B returns 5% a year and again it gets a 40% allocation. Asset C returns 30% a year. But because C is the higher risk asset with larger drawdowns, you only allocate 20% to C. So if you just allocate these positions in your portfolio and let them run, by the end of the first year, the allocations are now different. Asset A goes from a 40 to a 39% allocation. Asset B goes from 40 to 38%. And Asset C goes from 20 to 23%. The highest returning asset is increasing its overall weighting in the portfolio, and the lowest returning asset is decreasing its overall weighting. If we go through the years, at the end of the second year, the allocations would be 38, 35, and 27%. After year 3, 37, 32, and 31%. The riskier asset C is now essentially the same overall allocation weighting as the safest asset B. Year 4, it's getting even worse. And by the end of year 5, the portfolio will have a majority of its value in asset C, 39%, rather than the original allocation of only 20%. It returns the most, so if left unchecked, 5 years later, the portfolio will be much riskier, totally out of line with what you originally intended. And this leaves the investor exposed if something bad were to happen to that riskier asset, which, let's be honest, does happen from time to time. So let me show you a real-world example to really hammer this point home. This will be very familiar to my fellow volatility traders out there. This is a portfolio showing an original allocation of 40% to the S&P 500 through the SPY. 40% to 20-year U.S. Treasuries through the TLT, and then a smaller 20% allocation to a high-growth short volatility ETF called XIV. Now, I know some of you already know where I'm going with this, but these are real numbers showing the actual live performance of those ETFs. So this portfolio from 2011 through the end of 2017 would have quadrupled the original investment, from $10,000 in 2011 to almost $40,000 in 2017. You can see it's far outpacing the benchmark Vanguard VBinks, which is a 60% stocks, 40% bonds balanced index fund. This SPY TLT XIV portfolio would have performed very well for those 7 years. The problem with this is, the original 20% portion of this portfolio dedicated to the higher risk XIV, because XIV was growing in value so much faster, by the end of 2017 it would have become 58% of the portfolio, with allocation to stocks dropping from 40 to 25%, and the safety position of bonds dropping from 40 to just 17%. At the end of 2017, this buy and hold portfolio was not even close to the original risk factor the investor intended. Now here's where things get interesting, or perhaps tragic for those that didn't understand portfolio rebalancing, because in early 2018, there was a massive volatility event that terminated the XIV. Volpocalypse, or Volmageddon as we call it. The XIV crashed 95% in a single day. Now, what's going to happen to a portfolio that has 58% weighting to that high-risk asset? Clearly a devastating loss, which would actually have brought the long-term performance of this portfolio back to below just a simple buy and hold of the Vanguard VBinks. Imagine that roller coaster ride. Going from thinking you're crushing the market and quite an investing genius, to being brought right back down to earth when things didn't go well. Now you might be thinking, well sure, that's the XIV, but I wouldn't have owned that buy and hold without making adjustments. That's great, I hope that you wouldn't. But I've seen the same thing happen to options traders. They think they're killing it with their higher growth strategies, so they let those allocations go. And then one terrible month, and their portfolio gets crushed. And couldn't the same thing be said about Bitcoin? High risk, high reward, no doubt. But if you let those allocations go without rebalancing, it's certainly possible that a bad week takes you right back to where you started. And even individual stocks. You get one of those high flyer cannabis stocks or maybe a biotech that's killing it for your portfolio, so you let it run. And then it hits a snag, government regulation, or maybe an FDA approval delay. It really could be anything. The point is, when we set our portfolios to adhere to specific risk parameters, it's very important that as time goes by and those values naturally change, that we continue to set that portfolio back to the original allocation. And that's what rebalancing does. I'm going to do a full follow-up part 2 video to this, showing you the 3 best ways to rebalance a portfolio, including my personal favorite, which I do call constant portfolio rebalancing. But let me just show you how effective it can actually be. That same 40% SPY, 40% TLT, 20% XIV portfolio is shown here in green, with the only difference being, this time it was regularly rebalanced to bring the allocations back in line with the original risk profile. And this is a massive difference. Not only was it far more consistent through the entire 7-year period with much lower drawdowns, but it also weathered the termination of XIV very well. You can see at the end there in early 2018, losing 20% of a portfolio in a single day is never going to be much fun. Now, of course, there are ways to avoid it and specific volatility metrics that would get investors to the sidelines well ahead of time. Feel free to subscribe to my community if you want to hear more about those. But anyway, in this case, because the investor rebalanced, it wasn't nearly as costly. And despite losing the XIV, the long-term performance was still far superior to the benchmark Vanguard VBanks. This investor would have been realizing those gains the entire time, so even if at the end of the line it suffered a major setback, it was still worth doing. That first investor without rebalancing can't say the same thing. Like I said, even if you're not a volatility ETF investor, quite often the same concept applies to many other assets as well. So options, futures, forex, crypto, cannabis, high-growth individual stocks, and many more. We invest in them because they have higher potential for that explosive growth. But remember, the flip side is also true. If precautions aren't taken, they have the potential to seriously hurt a portfolio as well. I'm not saying people shouldn't invest in them. I'm just saying that there are ways to mitigate that risk so that we can still participate in the upside. And one of the easiest and most effective ways is through portfolio rebalancing. If you're sitting on a big profit in any of those assets, maybe you're one of the lucky few who threw a few dollars at Bitcoin, and now several years later it accounts for a major portion of your portfolio because of all that explosive growth, portfolio rebalancing might be something to consider. So coming up in part 2, I'm going to go over the 3 best ways to go about that, including, of course, my personal favorite, constant portfolio rebalancing. So thanks for watching. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.